G'day, it's Jonathan Bayes with the November Investment Market Update. And portfolios continue to benefit still from very low interest rates around the world and still a tepid rate of growth. In the last month, we had some good news for the portfolio coming about on the emerging market side of things. The US and China look closer to forging a phase one part of a trade deal, largely focused on the agricultural side, which will benefit both economies. Markets seem to have taken heart by that. But the other thing that we think is quite interesting within our international holdings is what seems to be a bottoming out in the Chinese economy. We had a surprise bounce in the manufacturing data in October, which jumped to almost a 3-year high, and new order component part of that index was at almost a 5 or 6 year high. I don't expect that strength to continue, but it does seem to indicate, alongside a couple of other economic indicators, that the Chinese economy is bottoming out. Those other indicators are money supply growth, which for the last 6 or 9 months have been bottoming out in the 8 to 8.5% range, and also Chinese electricity production, which was also bounced off a low and now running in the order of 4.5 to 5% growth, giving a bit of a guide on where the economy is at. So there's parts of our portfolio that are exposed to emerging markets that have actually lagged in the last few months, and we're hopeful that the last 6 weeks or so of strong performance there can continue. On the local Australian economic front, we've been pretty hopeful since the mid part of the year that we'd see the bottom in the economy between now and Christmas. We've had precious little reason to support that view in the economic data, but maybe it's just starting to turn. In last month's data, we saw a bottoming or a stabilisation, if you will, in building approvals. The really strong auction clearance rate that we've seen the last couple of months along the eastern seaboard, I think, is very, very supportive for the domestic construction industry, and we're already starting to see house prices push higher. So feel pretty confident that on the construction side of things, that things will start to improve. But also importantly, on the consumer side of things, in October, the Australian Industry Group data on the service sector came in at an 11-month high. The sales sub-index, which is a pretty good guide for broader service sector activity, came in at an 18-month high. And it just feels a bit inevitable that with the interest rate cuts, the weak Australian dollar, the tax cuts that are coming through, and the prospect indeed for further tax cuts, on top of the rebound in house prices being a really positive driver for household wealth and confidence, that things will start to turn, and that as we look into 2020, people will feel a little bit more optimistic on the economy. And as a result, within our portfolios domestically, we're trying to improve and increase our exposure to the consumer side of things. So again, our small companies exposure, Webjet, and our exposure through Boral and Reliance Worldwide on the construction side.